Let's go. Testing one, two, three. Happy Monday, everybody. Let me get rid of this music. Boom. Hello, 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 everybody. Chiming in on the chat. Good to be with you tonight. Happy Monday. Got some exciting things to share with you today. I was talking to my staff today, man. I love what I get to do. To be straight, I hope that's like you. You get to wake up in the morning, look forward to what you're doing with the people that you're serving, and the things that you get to do every day. That's me. I love it, man. I love being able to help people with things like this because there's a future that people get to live into where they get to have it all. And you get to have it all because you're here in this conversation tonight with me. All right. And again, man, it's so great being with you every single week to share with you like this in this way. Hopefully, you have some bring your questions along. There's going to be some things to talk about tonight because we're going to get into some scenarios inside of what we're talking about today. And come on, let's get started with this really quickly, guys. Let's go. So this tonight's agenda, man, we're talking about we're going back over C Corps to make sure it's clear for people. That was something that that was present to me the last time we were on this call. I was like, okay, people really want to talk about C Corps and stuff. Like, well, how do we use those? Where do they come into play? Well, how can we avoid the confusion with them? So I want to bring those back up just to briefly go back over those. And I want to talk about, well, if you're starting a business, if you're looking to own some type of business, if you're looking at improving the way you're running your own businesses, what kind of business should you create? What should you be deciding for yourself? Like, how can you eliminate all the confusion? Okay, so we're going to get into some cool things around that and some pretty cool scenarios with that too, to talk about, share with you guys, to get your head spinning about what you can possibly do here inside of the world of business. And we call it freedom, wealth, and legacy, baby, over in these parts. That's what we call it. All right. So let's go. Before we get started, here we go. Quick disclaimer. If you didn't know, now you know that's me. I was on the call with my daughter before. She was like, man, Dad, you like chiseled down. I'm like, yeah, I did chisel down. We've been on this program, my wife and I. Shout out to Mrs. Bolchin. Shout out to you for being on this whole journey with me on that, and chiseled up inside of that whole process. So you see that now. I gotta get some new clothes, man. That's what it gets to be. I get to get some new clothes. All right, because I lost a good amount of weight. Again, Summer Sexy's coming here. It's just here right now. Summer Sexy. Let's go. All right. So that's what that's about. By the Books Consulting is a company that we're bringing to you. My name is Cheston Bolgen, and just in case you did not know, senior consultant here at the company. I'm the founder of By the Books Consulting. Pretty good team, great team, significantly great team that we have over here at By the Books Consulting when it comes to having your back in these areas. You can reach us at 888-4BTB now. That's 888-4BTB now. That's 888-428-2669. And right now you can reach us at youraccountingsuperhero.com. You can also reach me at Cheston at youraccountingsuperhero.com. So make sure these are updated slides, by the way. All right, with the updated contact information. I was recycling some of the old slides, coming back to the old information, but not really old, but foundational information. And here's this one of the slides that we had from then. And we help people with the accounting, the technological systems like QuickBooks Online to help you run your business and accounting functions. And if you have a fleet management software that you use, we help out with those things. If you're in the construction industry, same thing, we help out there as well with that. We do the tax strategy and the tax planning, in the business advisory. We actually help people on a CFO level without having equity in the company. We're like your CFO partner in that process is what we get to do. All right, so that's enough about that. That's what we do. And quick disclaimer before we get started with everything we're about to get started with today. The following is for educational purposes only and is not to be considered financial accounting or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. Okay, so we're going to give you a good amount of information today, and you're going to understand why you want to consult your tax and accounting and legal professional when making these choices for yourself, because you just don't want to go with anything that you see on the internet. Even in this conversation, I'm giving you some pretty good information here. You want to make sure you check in or for yourself in your specific circumstance and situation. What this will allow you to do, this conversation that you're in here with me today, is to have a pretty high level conversation with your partners in that area. Okay. If you don't have a partner in that area, of course, you can reach out to us. And just really quickly, I want to just go back over what we talked about before with flow through entities, pass through entities, because it's going to help understand the differences between what they are versus what we're going to talk about tonight. Flow through entities are not taxed, but are required to file a tax return to reconcile the income of the owners or shareholders. In other words, the income generated by these entities are taxed at the individual level. The income is passed through to the owners. So if you can think about it like this, it's like really the entity serves for, like two things that you want to look at when it comes to entities. Really three things. We're going to talk about those three things that you want to look at. Okay, and there are two main things. And the two main things you want to look at when selecting entities are asset protection and tax efficiency. Okay, two main things. The other thing we're going to talk about is ease of management efficiency. Like, what are you looking to accomplish when you're looking to manage that business? So we want to consider those three things when it comes to optimizing your complete picture and what you're going to do when you choose your entity for your business. Okay, so flow through entities, they're pretty great because for tax purposes, it really simplifies your income structure on the individual level. You don't run into some of the headaches you're going to run into with C Corps, like we're going to talk about, like double taxation. You don't have to worry about that. And that's pretty cool in and of itself. You have a pretty solid and clear financial statement on your tax return is what I want to say. Okay, and like when it comes down to creating a tax return for yourself individually, it becomes very simple. You don't have to deal with that one thing. And when it comes to tax obligations, if that makes sense. Okay. Now the difference is when we start talking about C corps, and we want to complete on this first, guys. Partnerships are example of pass-through entities. S corps are examples of pass-through entities. But then we're going to come to C corps, okay? So C corps, they're no longer considered pass-through entities. As we discussed earlier, man, it's like, well, pass-through entities means the income belongs to the individual, the owners who own that company. The income belongs to the owners that own that company in a pass-through entity. The income belongs to the owners that own that company in a pass-through entity. Hopefully I'm saying that where it makes sense to you guys. It belongs to that owner. Whereas a C corp, it's different because the income is not the owners. The income is the company's. Okay, that's the difference when it comes to tax purposes anyway. Okay. Now, if you can understand that that income belongs to the C corp, it does not belong to the owners or the shareholders or members or whatever that is. That's the conception about how other entities operate. All right. If you can get that separate in our minds, it'll make it a lot easier to understand why C corps are different. Okay. Completely separate when it comes to income. Now, if you can think about it too, like there's a complete separation when it comes to asset protection, like it's a separate entity, which, by the way, like corporations in general, whether you're S corp, C corp, LLC, they all provide the same corporate veil structure over them for asset protection, As long as we're operating compliantly within the structure, they'll protect whatever the assets are. They'll leave the liability of whatever's inside of that body. Whatever liability is inside that body is liable for whatever assets are owned inside that body, but nothing outside of that body. Okay, so it doesn't extend beyond that cover, that protection, the liability. So it's housed in that one entity. Whereas if we didn't have that structure, like if a sole proprietor, they don't have a structure like this, like an LLC or corporation, or any type of separate entity to protect themselves. Well, there is no veil to keep all that liability restricted to just the assets of the business. The assets of the individual, they're all at risk for the operation of that business. It's all the same. So this is the main difference between these types of entities. All right. So now if you look at it, there's asset protection. Yes, every corporation like LLC, and they provide the corporate protection. But the C Corp is a little different because it has another layer of separation when it comes to income. Because those other entities like S Corp and S Corp and like LLCs, they're treated as for, like, if you have a single member LLC, there is no separation of income at all because it's treated like a sole proprietor. Okay, so if you get that, it makes sense to you. Like, okay, they have a sole proprietor income; it just belongs to the sole proprietor. If it's more than one person operating that LLC, if there are more than one, two people or more in that LLC, is treated as a partnership. It's passed through again, right? Passes through to those partners inside the partnership. Okay. Now, if we're looking at a C Corp, completely different animal when it comes to that, when in income. It has its own income and has its own income tax, so it gets taxed at that corporate level. And then also, here's the other thing: if you're going to take money out of that C Corp for yourself, and there is a requirement for for dividends for single owner C Corps. So it's required that you must, okay, take at least a dividend from that. Okay. Well, then you're going to be forced to have double taxation because those dividends, when you receive them as a shareholder, okay, as a shareholder, single shareholder of that C Corp, that money comes to you, whatever dividend that is, that's also taxed at the individual level. Okay, that's the term double taxation. It was already taxed at once. Then after that, you issue a dividend to the owner, which could be you if you have a C Corp, and then, well, that is also taxed at the individual level at the corporate tax rate, or the capital gains rate. Okay, capital gains rate. All right. So now, hopefully, that makes sense now, and that's clear for everybody that's in with me on this call. Is that C Corps are pretty unique from that perspective. And why would anybody want to do that? Okay, if you have benefits of not having double taxation, which is what we just said, being taxed twice on the same money, and if we are going to do that, why would that make sense ever to do that? Well, it depends on, like what we said, your overall goals. So how do you know what to choose? Okay. So I want to reinforce what C Corps are. We're going to get into that really strongly about how to really choose an entity for yourself and what kind of scenarios we get into by choosing these entities for your business. Okay. Now, main benefits. This is why. Okay. This is why number 2 is why people want to get into a C Corp. Number 1 is protection. This is why C Corps are good. Number 1 is protection. Yes, we talked about that. All corporations, whether it's an S Corp or even a limited liability company, it gives the same protection, right? But so what's the main benefit of a C Corp then? Capitalization. Okay, now the main benefit. Why? There's no restrictions in that. It doesn't make sense for somebody like Main Street Joe Smith, business owner, to go out here and get a C Corp just because he heard it was like great for protection. Okay, it was like the best way to protect himself. If that's the only reason that you're looking to get an entity, then you probably don't want to do this. Okay, because you're not going to get much more benefit, but you're going to have a whole lot more costs inside of the process. Cost and double taxation. There's some administrative costs to consider with that as well. And you want to make sure like you understand it's worth it. But why would it be worth it? Now we talk about capitalization. That's pretty cool. Okay, capitalization with a C corp is unlimited. Why? Because in terms of like an S corp, let's look at the different corporations that we have. We have an S corp. If we can remember back when we're talking about S corps, one of the things that we deal with is like you're limited to 100 shareholders or less in an S corp. Well, you don't have those limits in a C corp. You can have unlimited shareholders, so you can go out here and raise so much capital inside of a C corp. So if your goal is to raise like unlimited capital for your business, and like you need to reassess positions, you're looking to go big, you're looking to have a whole lot of capital raised because that you're going to have different people that you're going to sell shares to. You have that strategy in place. You're going to have that strategy in place to keep raising capital. Let's say you want to raise $10 million in droves, for your C corp, for your company. Well, this might be the route that you're looking to take, because now you can start adding unlimited shareholders. You can issue thousands and thousands of shares to raise that $10 million. Okay. Depending on your capitalization goals and the valuation of the business. Okay. But there's no restriction to that, which is pretty cool. It's pretty awesome. This is what most companies, every company that's on that's publicly traded must be a C corp structure for this reason. Okay. So it really makes sense for them. Yes. Doesn't make sense for you. I don't know. Right? It might not, So that's main difference, main benefits there that you want to think about when choosing the C corp. Now, the other thing is, when it comes to doing it with a trucking company, the whole thing is, we talked about, we have the separate entity, separate tax, all that. That's the thing that we can really see. Now, the other thing I've heard is that, okay, I can build credit with C corp. Anybody ever hear that before? Right? Anybody? If you heard that, it's like people get C corp because they told you, man, I need a C corp because I need to build credit. Right? Just put that in the chat and put a 1 in the chat. If you've ever heard that before, that you can build credit with more so with a C corp. Okay. That's some misinformation, man. You can build credit with an S corp. The structure designed to do the same thing. You can build credit with an LLC. Right? Business credit, you can. Right? You don't need a C corp to build business credit. Okay, but it would be unwise to just go into the structure thinking that that's the only reason. All right, so that's one of the things I've heard as well. Inside of this process that could steer people off. So what I want to leave you with here is that you want to be clear-headed and clear-minded when it comes to selecting your entity here. You want to understand really what it is that you're dealing with, so you can make those decisions. Yeah, man, like people do that. People say that all the time. Like, I chose it because I wanted to build business credit, and then you end up with this structure, and it's a whole lot of administrative headache, and it's extra taxes, and like it's all kinds of stuff that's going on. They're dealing with, excess losses. Then they gotta. It's complex when they deal with excess losses with a C corp and everything. So it's like all this stuff goes into it, and now it's like, well, I have this thing, this entity. It's not really doing what I wanted to do anyway, beyond what I could have done with another entity, right? So that's the main thing to consider. All right. So let's talk about some things. All right. Let's talk about some things, real talk, in terms of like what we can do with this understanding now that we have it. I'm gonna start doing some polling questions, man, in this chat, because some of the time it's like it can be confusing, right? To be with like all this terminology. Like if you're thinking about it, it can be confusing as a business owner if you're out here and really you just want to run your business in the best way possible to run it. And it's all this information out here, and it's like, well, what to do, how to do it. Am I doing it the right way? And it would be fantastic for you to have a foundation of what it is from the start, so that you're not getting yourself into unnecessary headaches that you would have to unravel down the line, and becomes just a pain to do that. And I've seen how that goes with people. It's not fun. It's not a fun process for people to go through. Okay, and it can be something where up top, up front, if you get it set up the right way, it can be really simple, powerful, and you win. You win, and you keep on winning from this. So, how are you going to decide? Let's talk about that. The main things to consider when you are selecting your entity. Okay, so let's do this. I'm going to share this, guys. So what are some of the main things to consider when you're selecting your entity? There are three main things that we want to consider. By the way, guys, those of you who stay to the end, I'm throwing another opportunity to get on a free tax consultation, and then we can cover some of these things with you specifically. 30 minutes. That's what you get with me. All right. So if you're here till the end of this conversation, I'm going to throw that in the chat and you'll get access to a link to schedule with me to go over this for your particular situation. Okay. For free. Free. All right. That's my promise to you inside my communication. So I make sure that gets put out here today, guys. Okay. So what things are there to consider? Considerations for choosing your entity. And we can keep this pretty simple and straightforward anytime that you go into that whole process. Like you want to understand what you're doing for number one from the start with the company. What's the intention for the company? Okay. So there are three things to consider when selecting the intention. Number one, we mentioned this earlier on, asset protection. Number two, tax efficiency. And number three, management efficiency. All right, so if I'm thinking about it, all right, if I'm thinking about this whole process, and I'm looking at these three aspects, the one thing with asset protection, what does that mean for me? Like, okay, well, at some point, I definitely from the beginning, I want to protect whatever I'm doing with the business. Well, I want to protect myself from whatever the business is doing. Okay, that's number one, asset protections. I want to protect myself from what the business is doing. I also want to protect the business for what I'm doing. Okay, that's also protection. So if scenario number one, you own a trucking company and you got this truck and drivers going down the road, God forbid, driver's like pushing it, and he didn't really do his full reset, like for the 10-hour reset. He said he did it, in some way, some shape, or form, somehow he didn't do that. He did something else instead of going to the sleeper and getting at least 8 hours in the sleeper. Okay. And he gets up, he goes out, he drives, and he likes to drive like a whole lot of drivers I know like to drive. They like to drive overnight without all the people in the way. They say, okay, yeah, let me get my driving shifting. I got to make my time. I got to make my delivery, right? I got to get it in. And they keep going. And they start seeing like purple dinosaurs on the road, like over the trees and everything. Like, wow, that's pretty cool. Right. And they're just paying no mind. They just keep on going. It's just like it's all right to see purple dinosaurs walking beyond the trees. And they keep on going, they keep on driving. And all of a sudden, they find themselves, God forbid, causing a catastrophe on the road, having an accident on the road. Now, man, it sucks. All right, because people go through that. Like that's real stuff that happens, guys. Real stuff that happens. And what if you have a whole lot of other stuff going on personally? Right? You got like savings and everything that you have for your kids. You have like retirement savings and everything. You have, other operations going on, like, and like personal investments like real estate, all this other stuff you got going on, and you built up and accumulated a whole lot of other stuff. Well, all of that's at risk now if you don't have the right asset protection strategy in place. Okay. That's why you have that. Okay. To stop that scenario from happening. Conversely, if you're out there on the road, or even if like your kid, you have old driving kids and they're out there and they're texting and driving and all of a sudden they're not paying attention and boom, they get into an accident. Well, now they find out that this business is something that has assets. Well, those are at risk too if you don't have the proper asset protection strategy in place. Okay, so that's why we do that. That's the main reason. Number one. Number two is tax efficiency. Okay, so tax efficiency just means that I don't want to pay so much in taxes. How can I pay as close to zero as possible with what I'm doing out here? Okay, so we think about the considerations for that. When we talked about, self-employment taxes that are there for people, we talked about, okay, well, what eliminates my exposure to self-employment tax? What, like, does double taxation work for me in the scenario with the C corp? Probably not for me in my particular situation. S corps are really good for reducing self-employment tax exposure, so I'm not going to have that extra tax exposed. So I'm looking at all these things. I'm looking at, man, if I'm just a sole proprietor, I don't have either. I don't have asset protection. I don't have any tax efficiency. He's like, what? That kind of sucks going out here in business where I'm like that because I have no optimization at all. Right. So now it's starting to come together where you're choosing what makes sense. Okay. And then we're talking about management efficiency. This is where people kind of get lost and confused. Is number three, because people really don't think about number three a whole lot. What is management efficiency? Well, how easy is it going to be for me to run this business? Okay, that's management efficiency. How easy is it going to be for me to run this business and achieve the business goals? All right, so that could be something else, entirely different. Okay, because number one, let's say you just have, you have this company, like it's a construction company, and inside this construction company, you think it's pretty cool that, to operate real estate inside of, like, own real estate and everything and have like rental real estate inside the construction company. It might not make sense to do it that way. Okay. Why? Because, for one, why the extra assets are exposed now to the operating of one business, right? Versus the other. Anything happens on a rental, the trucking company's at risk, the construction company's at risk. Anything that happens with the construction company, the rentals are at risk. Okay. So that's completely out of the question. If you really want to have things work the way you want them to work, hopefully it's starting to click, guys. Like, you can start really thinking about these scenarios like this. Okay. Now, in other cases that are not less easy to see is, okay, well, I want to be able to make really great decisions and make them fast. Well, if I'm going to do that, I probably don't want a C corp structure because there's some type of corporate governance, like a board and everything that wants to be in place. A lot of red tape that goes along with that. That might not necessarily work for me with what I want to do because I want to make my decisions. I want to have control. It might not work for me to have a partnership, because I got to deal with people unless maybe it's a limited partnership, right? Where, they'll have silent partners because I like to make decisions. I like to move, thinking about those things. Okay. Pretty cool, right? Pretty cool to start thinking about. Now, what if your goal is just really, I need a real solid asset protection and I need to keep growing assets. I do. I really do want to do that. So we had a situation with company, man. They're growing like 10 million in assets. They've grown trucking company. They're growing about 10 million in assets that they have. Well, imagine this: you're working and building up all this equity in assets and everything else. You're building up all this wealth inside of the business over time. And you get to a point, it's like, well, man, I'm still operating this business. I didn't start out with all this, but now I have it, right? So what do I do? What do I do? Because now there's the thing here, because everything that I've worked for, it's inside this body. And now everything that I've worked for that's inside of this body is completely at risk. Right. So how do I manage this? How do I manage this? All right. So sometime you might want to start breaking off and forming a new entity for the purpose of managing those assets and distributing those assets. So guys, if you like, I want to know, man, if you guys is this making sense to you, getting some value out of this newly, let me know. Put a number 2 in the chat if you're getting value out of this newly. If you just didn't even understand this from the beginning, but now you start to see the picture of how these come together and how you can start making these decisions, let me know. Give me the feedback. All right. Now, this is the beginning of things. Okay, when it comes to understanding, selecting the right business entity for yourself, when like going in from the start and saying, okay, this is what I want to do. We've had situations with people, like scenarios, where people have built up a whole lot over time, and they've been structured in ways that don't necessarily serve what the intention is for their life and the way they want to run business. So, for example, anytime that you're dealing with operating, which means that you're conducting business with like people actively and like consistently, and by definition, it creates like an exposure to some risk, like enhanced exposure to risk because you're dealing with people, right? And anytime we're doing that, we call it operating, okay? Everything wants to be, everything wants to have asset protection inside of it. But we want to think about it like this. So I'm going to go out and operate. I'm operating, which means I'm like day in, day out, like transactions with people. People and businesses. Basically, that's what that means. Like a lot of transactional activity with people and businesses. Well, there's an enhanced level of risk exposure to whatever that is. So if I have an enhanced level of risk exposure to something that's operating with the day-to-day people, do I want to have a whole lot of assets at risk inside that company? Probably not. Okay. I would like to have assets shifted to I most likely want to have assets shifted to non-operating. The terminology for that is passive. Structure. Make sense? Why? Well, why would that make sense? Why would it make sense to shift things to things that are non-operating? Meaning that it's not really like high volume dealing with a lot of people, like a lot of transactions. I'm not dealing with like a high volume of transactions with people or businesses. Okay. I'm saying that makes a whole lot of sense, doesn't it? You're right. People don't even think about this, but it's like makes a whole lot of sense to do it like this. Now, I would have I would have over here at the left side, I would have low assets, high exposure, low assets. Now, this is from number one. I'm not actually looking at number one inside of my decisions, asset protection. That's if we can correlate that, we can link that up. That's what I'm looking at. Number one, asset protection. Okay. So operating side is high exposure. All right. So definitely, man, I want to have low assets held in this. So there's going to be a point because the business is going to keep operating, because when it operates successfully, it's going to keep building equity. Right? It's going to keep building equity because profits, right? So assets are going to grow. Asset base is going to grow continually, right? So this is a moving, breathing plan here. Get that? It's a moving, breathing plan that wants to be revisited quarter after quarter. Okay. Get that? Okay. That makes a whole lot of sense, right? Because as you're moving, as you're increasing assets, like for example, this company I'm talking about, they didn't start out with $10 million worth of assets. They didn't start that way. But they all of a sudden it's like, wow, it's here. What do I do? Because it's like, we got to think about that now. Because if something happens, it's all at risk. And some people think it's like insurance. You notice I haven't talked about insurance in this scenario. It's good. Like, I'm not saying insurance is like something you don't want to have. You definitely have to have and want to have good insurance. Am I going to confide and trust in the fact that the insurance is going to take care of my assets? I got to cover my own assets, man. I got to cover my own assets. And, in terms of like making sure, because I'm not going to leave it up to the insurance companies knowing what I know about insurance companies to protect my ass. That's okay. All right. Now, let's get it. So if I have high exposure to risk, then I want to have low assets over here. And if I'm over on this side, well, it has low exposure. High assets. Now we start breaking it down, like in terms of, okay, well, we know that in terms of number one, but there's a combination that kind of branches off and the matrix is beyond that. And when we get to start talking about number two, when it comes to tax efficiency, okay, because on this side of it, the non-operating side of the equation, you don't have exposure, no SC tax. Because it's passive and not earned income. Like self-employment tax deals with earned income, so it's earned income. So I don't have to worry about that on that side. That's pretty tax efficient already. Okay. Now watch that, right? Tax efficiency already. Okay. High assets. All right. Also has high assets, so lots of deductions. Deduction optimized. So like especially if it has a lot of fixed assets, depreciation, and also like the expenses that go along with like those assets on the books, like the repairs, any type of things that go along with that, they're deductible, right? So it's getting a lot of deductions for that too, right? So we're thinking about number two now, tax efficiency. Look at that. Okay. And pretty hands off, right? So it's management is like easy management. Okay. Easy management. All right. So we wouldn't need a whole lot going on there in terms of like structures. Like we need simple structures for that right side. Okay. This is what I want to bring to the surface when it comes to choosing entities for anything like this. Wow. Kind of cool, right? To think about it, like, man, it makes sense now. I can make decisions on what entity to get. If you start thinking about, well, if I just need the LLC really over here, That gives me good protection. I don't need to worry about self-employment tax because if I were gonna earn income on that side of it, then I would have to deal with it. But I'm not. So an LLC works in that scenario because I'm not going to have to deal with self-employment taxes. It can be a partnership because like the management decisions over there are not big deal decisions. To move and operate each and every day. So even if I have partners involved with it, that's pretty easy to manage the people because their decisions are not really complex. Okay. What? Look at that, man. There's more to go with these things, guys. We're about to go over the time that we allotted for this. So I want to start wrapping this up and leaving you with this, but I want you to get to the point. I want you to get to the point of this, which is to understand how to make decisions when it comes to creating your entity. Some of you have gone out here and created entities. They started out, you don't really have an understanding as to why you created them the way that you did in the beginning. But now you can go back and revisit it to see if it's actually performing in the way that you want it to perform. When I say perform, is it doing what you want it to do for you and your business? Okay. Now that you know how to make these decisions, go ahead and revisit that. Get with your professional. I said if you stayed on to the end, and then I'd give you an opportunity to do that with me. Okay. Free consultation and everything. All right. So let me put that in the chat. If you've done this before, you're not allowed to do it again. Okay. If you've done this before, you're not allowed to do it again. This is for new participants only. If it is a second time, it is a paid consultation. Okay. All right. But this is for people who are first time and have never used this link. You are staying on this to the end. Let's go. There it is for you. All right. Those of you who are watching in the YouTube channel, definitely you got that for yourselves. All right. It's been fantastic being with you. If you had a great time being here in this conversation with me, put a number 3 in the chat. That's been great being with you for me. So I'll go ahead and put a number 3 in there myself. Number 3 in the chat myself, because I enjoy speaking with you about these subjects, because I really do feel that this is like what I love to do with people, to help them make sure they're solidified in terms of their business and their life goals. That combination there. All right. So, even having this basics, I think the fundamentals are essential to making sound decisions. Like making these are fundamentals to me. Like these are the basics of it. So now you can go out here and reassess like your decision making when it comes to running your businesses, selecting your entities, and how much peace, ease, and clarity you can create in your life and attain freedom, wealth, and legacy with your business. Guys, it's been great being with you once again. Justin Bolgen, your accounting superhero. Talk to you next week. Take care. Actually, guys, next week, I will not be having this session with you guys. All right. I will not be having this session with you guys next week. All right. We actually doing some traveling meetings next week. All right. And making sure my niece is graduating from high school up there in Zebulon, North Carolina, guys. Give it up for my niece, Morgan. Morgan is my niece. She's graduated from high school, man. She's a sharp individual, man. Bright individual, sharp person. Proud of her, so she gets to graduate. So I'll be up in that area checking her out for her graduation. And I'll be visiting some people, man. I'll be moving around and visiting my peoples up there in that Raleigh, North Carolina area. All right, guys. But I'll see you the following week, guys. All right, take care until then. Have a good one. Bye-bye.